The day Wall Street died, the morning of September 15, 2008, began like any other Monday on Wall Street until it became the most devastating day in American financial history. At precisely 1:45 in the morning, Lehman Brothers Holdings filed for Chapter 11 bankruptcy protection, setting off a chain reaction that would ultimately devastate the entire global economy. Lehman Brothers was not some obscure hedge fund that nobody had ever heard of. It was the fourth largest investment bank in the United States, a financial institution with roots stretching back to 1850, that had weathered every crisis America had faced over more than a century and a half. The firm held $639 billion in assets and employed roughly 26,000 people in offices scattered across the globe. When a company of that size and pedigree suddenly ceases to exist, the consequences extend far beyond the employees who lose their jobs or the shareholders who lose their investments. What made the Lehman collapse so uniquely catastrophic was not simply its size, but its interconnectedness with virtually every other major financial institution on the planet. The bank had borrowed from some firms, lent to others, and entered into complex derivative contracts with thousands more. When Lehman filed for bankruptcy, every single one of those relationships instantly became a potential loss for someone else in the financial system. The stock market responded with immediate and brutal force on that Monday morning. The Dow Jones Industrial Average plummeted more than 500 points by the closing bell, marking its largest single-day decline since the terrorist attacks of September 11, 2001. But this was only the beginning of the carnage that would unfold over the ebb. Following weeks and months, the Lehman bankruptcy did not merely coincide with the Great Recession, but directly triggered it. Within 18 months of that September morning, the American economy would lose more than 4% of its total output. Unemployment would double from 5% to 10%, and household wealth across the nation would decline by more than $10 trillion. What followed would become the worst economic catastrophe since the 1930s, and it all began with the collapse of a single investment bank. 158 years to build, 18 months to destroy the institution that collapsed on that September morning had origins far humbler than its eventual status might suggest. In 1844, a 23-year-old German immigrant named Henry Lehman arrived in the United States and opened a small dry goods store in Montgomery, Alabama. His younger brothers Emanuel and Meyer joined him over the following years. By 1850, the business had been renamed Lehman Brothers. The three siblings quickly discovered that cotton trading was far more profitable than selling household goods, and they shifted their operations accordingly. The firm relocated to New York City after the Civil War and gradually transformed itself from a commodities trading house into a full-fledged investment bank by the early 20th century. Over the decades that followed, Lehman Brothers built a reputation as one of the most respected names in American finance. The company helped take major corporations public, advised on mergers and acquisitions, and managed money for wealthy individuals and institutions around the world. The man steering this institution in its final years was Richard Fuld, a hard-charging executive who had spent nearly his entire career at the firm. Fuld had joined Lehman in 1969 and worked his way up through the ranks over 4 decades. By 2007, he was the longest-serving chief executive on Wall Street and had built a fearsome reputation for his aggressive management style and willingness to take risks that competitors avoided. Under Fuld's leadership, Lehman had posted 14 consecutive years of profits heading into 2008. The firm reported record earnings of $4.2 billion in 2007. And Fuld himself had collected nearly $500 million in total compensation since 2000. Wall Street analysts praised his stewardship, and the financial press regularly featured him as one of the most powerful figures in global banking. But behind the impressive quarterly reports and the confident statements to shareholders, Lehman Brothers had placed an enormous bet that would prove catastrophically wrong. The firm had loaded up on mortgage-related securities at precisely the worst possible moment in history, and nobody at the top seemed to recognize the danger until it was far too late. The mortgage machine, to understand how Lehman Brothers destroyed itself, you first need to understand the financial alchemy that Wall Street had perfected in the years leading up to the crisis. Banks had figured out how to take thousands of individual home mortgages, bundle them together into securities, and sell those securities to investors around the world. This process was called securitization, and it transformed the American housing market into a global casino. The basic concept was straightforward enough. A bank would make mortgage loans to home buyers, then package those loans together and sell them to investment firms like Lehman Brothers. Lehman would then slice and dice these mortgage pools into different tranches based on their risk levels, repackage them as new securities called collateralized debt obligations, and sell them to pension funds, insurance companies, and foreign governments looking for safe investments with decent returns. The ratings agencies played a crucial role in making this machine work. Firms like Moody's and Standard & Poor's would examine these mortgage bundles and assign them credit ratings. The safest tranches received AAA ratings, the same grade given to United States Treasury bonds. Investors trusted these ratings implicitly and poured trillions of dollars. QDs they believed were virtually risk-free. The total value of mortgage-backed securities issued in America nearly tripled between 1996 and 2007, eventually reaching $7.3 trillion. The market for collateralized debt obligations exploded from $300 billion in 1997 to nearly $2 trillion by 2006. Fees from structuring and selling these products generated billions in profits, and the bankers who created them collected enormous bonuses year after year. But there was a fatal flaw buried deep within this elaborate system. The mortgages underlying all of these securities were increasingly being given to borrowers who had no realistic ability to repay them. These subprime loans carried adjustable interest rates that started low but would spike dramatically after 2 or 3 years. Lenders approved applications with little or no documentation of income, creating what the industry euphemistically called stated income loans, but what everyone else called liar loans. As long as housing prices kept rising, none of this seemed to matter. Borrowers who fell behind on payments could simply refinance or sell their homes at a profit. But when housing prices stopped rising and began to fall, the entire edifice started to crumble. And Lehman Brothers was standing directly in the path of the avalanche. The bet that broke the bank, Lehman Brothers, did not simply participate in the mortgage securitization business. The firm dove in headfirst and kept swimming deeper, even as warning signs began flashing throughout the financial system. By the end of 2007, Lehman held more than $111 billion in commercial and residential real estate assets on its balance sheet, more than double what it had held just 12 months earlier. Richard Fuld and his senior executives had convinced themselves that real estate was a one-way bet that could only go up. They believed that even if some mortgages defaulted, the underlying properties would retain enough value to cover any losses. This assumption had been true for decades, and there seemed to be no reason to question it. Housing prices in America had not experienced a significant nationwide decline since the Great Depression. The firm used borrowed money to amplify its bets, a practice known as leverage. Every dollar of its own capital, Lehman borrowed roughly $30 more to invest in mortgage securities and other assets. This leverage magnified profits spectacularly when times were good, but it also meant that even a small decline in asset values could wipe out the firm entirely. The first major warning arrived in March 2008, when Bear Stearns, another storied Wall Street investment bank, collapsed under the weight of its own mortgage losses. Bear Stearns had been the 5th largest investment bank in the country, and its sudden failure sent shockwaves through the financial world. The Federal Reserve orchestrated an emergency sale to J.P. Morgan Chase, providing government guarantees to prevent a complete meltdown of confidence in the banking system. The Bear Stearns rescue should have served as a wake-up call for Lehman and every other firm with heavy exposure to mortgage securities. Instead, Lehman's leadership largely dismissed the parallels. They insisted publicly that their firm was fundamentally different and far better positioned to weather any storm. Behind closed doors, some executives expressed concerns about the firm's vulnerability, but these voices were ignored or silenced. Throughout the spring and summer of 2008, Lehman's stock price continued to slide as investors grew increasingly nervous about the firm's real estate holdings. The company reported a staggering $2.8 billion quarterly loss that stunned Wall Street analysts who had believed the firm's assurances of financial strength. The foundations were crumbling beneath Lehman Brothers, and the collapse was now only months away. The weekend that changed everything. By early September 2008, Lehman Brothers was bleeding out in full view of the financial world. The firm's stock had lost more than 90% of its value since the previous year, and rumors swirled constantly that bankruptcy was imminent. Potential buyers and investors had been circling for months, but none had been willing to pull the trigger on a deal that might saddle them with tens of billions in toxic assets. The final act began on Friday, September 12th, when Treasury Secretary Henry Paulson and Federal Reserve Chairman Ben Bernanke summoned the chief executives of every major Wall Street bank to the New York Federal Reserve Building in Lower Manhattan. The message delivered that evening was blunt and unambiguous. The government would not be providing financial assistance to save Lehman Brothers, and the assembled bankers needed to find a private sector solution before markets opened on Monday morning. Two potential buyers emerged during that frantic weekend of negotiations. Bank of America initially showed serious interest in acquiring Lehman, but executives there quickly concluded that the firm's real estate losses were too large and too uncertain to absorb without government help. When it became clear that no federal backstop would be forthcoming, Bank of America walked away and turned its attention to Merrill Lynch instead. The remaining hope was Barclays, the British banking giant that had been pursuing Lehman for months. Barclays executives worked through Saturday and into Sunday, hammering out the details of a potential acquisition. The deal appeared to be moving toward completion until British regulators intervened at the last possible moment. The Financial Services Authority in London refused to approve the transaction without a shareholder vote that could not be completed before Monday, effectively killing the rescue. By Sunday evening, Lehman's fate was sealed. The firm's executives gathered at their Midtown Manhattan headquarters to prepare bankruptcy filings while employees wandered the hallways in shock, carrying boxes of personal belongings and wondering what had happened to the careers they had spent years building. Lawyers worked through the night to complete the paperwork that would formally end 158 years of continuous operation. The decision to let Lehman fail remains one of the most controversial choices in American economic history. Paulson and Bernanke have maintained for years that they lacked the legal authority to rescue the firm. But critics argue that creative solutions could have been found if the political will had existed. Whatever the truth, the consequences of that weekend would soon become catastrophically clear. Contagion. The collapse of Lehman Brothers did not remain confined to a single failed bank for even 24 hours. The financial system that had appeared so robust just days earlier began unraveling with terrifying speed as panic spread from institution to institution. The first casualty emerged on the very next day. American International Group, the largest insurance company in the world, suddenly found itself on the brink of collapse. The company had sold hundreds of billions of dollars worth of credit default swaps, essentially insurance policies that promised to pay out if mortgage securities went bad. When Lehman failed, the value of those mortgage securities plummeted, and AIG faced demands for collateral payments it simply could not meet. The Federal Reserve had no choice but to step in with an $85 billion emergency loan, just one day after refusing to save Lehman Brothers. The rescue of AIG raised an obvious question that shook confidence even further. If AIG required immediate government intervention to survive, which other major financial institutions might be next? Nobody knew the answer, and that uncertainty proved almost as destructive as the actual losses. The machinery of global finance ground to a halt within days. Banks that had routinely lent billions to one another every morning now refused to extend credit to anyone because they could not determine which counterparties might be secretly insolvent. The commercial paper market, where corporations obtained short-term funding for their daily operations, seized up completely. Companies with decades of profitable operations suddenly found themselves unable to access the cash they needed to pay employees and suppliers. The Reserve Primary Fund, one of the oldest and most respected money market funds in the country, announced that it had broken the buck. This meant that investors who had deposited money, expecting to receive at least $1 back for every dollar invested, would actually receive less. The announcement triggered a panic as ordinary Americans rushed to withdraw savings from money market accounts they had always considered completely safe. 10 days after Lehman filed for bankruptcy, Washington Mutual became the largest bank failure in American history when regulators seized the institution and sold its assets to J.P. Morgan Chase Wachovia. The fourth largest bank in the country teetered on the edge of collapse and was eventually absorbed by Wells Fargo in an emergency merger. The shockwaves radiated outward across the Atlantic and Pacific within weeks. European banks that had gorged on American mortgage products suddenly faced their own existential crises. Governments in London, Berlin, and Dublin scrambled to assemble rescue packages for institutions that had seemed invincible just months earlier. The crisis born on Wall Street had become a global catastrophe. The human wreckage, the statistics that economists would later compile to measure the Great Recession, tell only part of the story. Behind every data point stood millions of individual human beings whose lives were being torn apart by forces they barely understood and certainly could not control. The job losses came in waves that seemed to accelerate with each passing month. Roughly 8 million Americans found themselves out of work during the worst of the downturn, a pace of destruction not seen since the 1930s. Factory workers who had spent decades building careers watched their plants close permanently. Office employees arrived at work to find security guards, waiting with cardboard boxes and instructions to vacate the premises immediately. The housing market that had fueled the crisis now became a source of ongoing devastation for ordinary families. By November 2008, approximately 12 million American homeowners found themselves underwater, meaning they owed more on their mortgages than their homes were actually worth. Foreclosure notices arrived by the millions as people who had stretched to buy homes during the boom years discovered they could no longer afford the payments after losing their jobs or seeing their monthly obligations spike unexpectedly. The destruction of household wealth reached proportions that few Americans had ever experienced. Between 2007 and 2011, 1/4 of all American families lost at least 75% of everything they owned, and more than half of all families saw their net worth decline by at least 25%. Savings accounts that parents had carefully built for their children's futures simply evaporated. Older workers approaching retirement discovered that the nest eggs they had accumulated over entire careers had been cut in half, almost overnight. The psychological toll proved equally devastating for many who lived through those years. Men and women who had defined themselves by their careers suddenly found themselves unable to provide for their families. The shame of joblessness drove some into depression and isolation. While marriages crumbled under the relentless financial pressure, small businesses that had anchored communities for generations closed their doors permanently when banks canceled their credit lines and customers stopped spending. Commercial districts and towns across America transformed into rows of darkened windows and vacancy signs as the economic contraction rippled outward from Wall Street into every corner of the country. The crisis that had begun with complex financial instruments traded by sophisticated bankers had become a catastrophe that touched virtually every American family. The reckoning, the government response to the financial crisis, arrived in waves of increasingly desperate interventions. Within weeks of Lehman's collapse, Congress passed the Troubled Asset Relief Program, authorizing the Treasury Department to spend up to $700 billion, purchasing toxic assets from struggling banks and injecting capital directly into financial institutions on the verge of failure. The legislation passed only after an initial rejection sent the stock market into freefall and terrified lawmakers into reversing their votes. The Federal Reserve deployed every tool at its disposal and invented new ones when the old methods proved insufficient. Interest rates were slashed to effectively zero for the first time in American history. The central bank began purchasing trillions of dollars worth of mortgage securities and government bonds in a program that came to be known as quantitative easing, flooding the financial system with cash in hopes of restarting the flow of credit. The banking system eventually stabilized, though the recovery for ordinary Americans would prove painfully slow. The recession officially ended in June 2009, but unemployment remained elevated for years afterward, and many workers who lost their jobs during the crisis never found their way back to comparable employment. The housing market would not fully recover until well into the following decade. Congress responded to the crisis by passing the most sweeping financial regulations since the Great Depression. The Dodd-Frank Act of 2010 imposed new restrictions on derivatives trading, created agencies to monitor systemic risks, and established rules designed to prevent banks from growing so large that their failure would threaten the entire economy. Whether these reforms actually succeeded in making the financial system safer remains a matter of considerable debate. Richard Fuld, the man who had steered Lehman Brothers into catastrophe, walked away from the wreckage with his personal fortune largely intact. He testified before Congress in October 2008, but offered no apologies, insisting that he had made reasonable decisions based on the information available at the time. When asked about executive compensation at a firm that had just destroyed itself, Full became defensive and evasive. He faced no criminal charges, and despite calls for accountability, kept the vast majority of what he had earned during the boom years. The question of justice haunted the aftermath of the crisis. Despite the destruction inflicted on millions of families and the evaporation of trillions of dollars in savings, not a single senior executive at any major financial institution went to prison for actions that contributed to the catastrophe. The system that had failed so spectacularly was patched up and put back into operation, leaving many Americans wondering whether the lessons of 2008 had truly been learned, or whether the seeds of the next crisis were already being planted.